Today, we're diving into a topic that truly separates successful traders from the rest. The skill of spotting the perfect trade setups, recognizing those goldmine trade opportunities that have a high chance of success, takes time, experience, and a keen eye. Trading blindly without a clear understanding of what you're looking for can be a costly mistake, resulting in a series of losses. In this episode, we're breaking down the key factors and rules to identifying optimal trade setups using the smart money concept. Plus, we'll be delving into specific trading scenarios that give key traders a clear advantage, taking you one step ahead of the market. So, stick around till the end for some golden insights and strategies to level up your trading game. So, traders, if that's something you're interested in, please give this video a thumbs up to show your support and subscribe to our channel if you are new. See you after intro. Welcome back, traders. So, let's get started. There are three essential criteria that we need to look for in the market in order to identify optimum trade setups with a high probability of success. The first and most essential confluence factor that we should always consider is liquidity. The market continually seeks to absorb liquidity to generate momentum. Essentially, liquidity serves as the lifeblood of the market,
playing a vital role in its overall dynamics and functioning. We can categorize liquidity into two separate types, the static and dynamic liquidity. Let's have a brief explanation of them. Static liquidity refers to the specific zones in the market where a large pool of money is resting, such as stop losses and buy or sell orders. When a trader gets stopped out of a position, the market absorbs the funds associated with that stop loss. It is often speculated that central banks or large financial institutions may manipulate the market, creating scenarios that deceive traders into believing they have a clear understanding of price action. To survive and thrive as a profitable trader, it is crucial to identify static liquidity on the chart. These areas where significant volumes of orders are present can provide insights into market dynamics and help prevent substantial losses. Liquidity can be identified in various areas on the price chart. 1 below equal lows and swing lows to above equal highs and swing highs. 3. Dynamic trend lines and channels. 4. Order blocks. 5. Support and resistance levels. 6. Fibonacci retracement levels. 7. Daily candles. Body and shadow. It is crucial to spot a liquidity sweep pattern that occurs before the price reaches our point of interest. This pattern indicates the absorption of liquidity and provides an opportunity to confirm the strength of our identified supply or demand area. We use liquidity sweeps as a confluence factor before entering a position. The underlying theory is that the market requires liquidity to sustain its movement. If the price fails to sweep liquidity before reaching a point of interest, there is a high probability that the price will utilize that zone as liquidity to fuel its momentum.
As we mentioned before, the second type of liquidity is dynamic liquidity. Dynamic liquidity refers to the features that determine the market direction and movement. In other words, the factors that drive market movements. The dynamics behind market movements can be boiled down to two key factors that consistently influence price direction. Internal and external price in the market always moves between two types of liquidity, internal and external. Imagine it like a continuous circle where price moves either from internal to external liquidity or from external to internal liquidity. We have extensively discussed liquidity-related topics in our previous videos, and you can find the links to those videos in the description below. If you haven't watched them yet, I highly recommend checking them out to gain a deeper understanding of liquidity in the Forex market. Once we have a solid grasp of liquidity dynamics, our focus shifts to the second confluence factor, market structure. We analyze where the price is likely to move and gain an understanding of the dominant direction. This involves identifying whether the price is in a downtrend or an uptrend. To do this, we begin by analyzing market sentiment on a higher time frame, such as the 4-hour or 1-hour time frame. Our goal is to identify both the mitigated and unmitigated supply and demand zones, those located behind and in front of the current price. This analysis ultimately allows us to determine which side, whether it's the supplier-demand side, currently controls the market. This is a crucial point that needs careful consideration because it helps us identify high-probability points of interest and valid reversal patterns. This prevents us from falling into traps caused by false reversal changes in market character and trading in the wrong direction. For example, consider a bearish market structure where sellers are in control. Price has formed a series of bearish break of structures and supply zones associated with the structure breaks. Now, in the following scenario, we see that price moved upwards after indicating a tiny rejection from the last supply zone. Price, broken, closed above it. Here we facing a common scenario that frequently occurs in the market. Many novice traders who haven't correctly identified the market structure often consider this upward movement as a change of character, a signal of a reversal in market direction. They believe that the bearish phase has ended, and it's an ideal time to go long with the newly formed demand zone. They typically place their stop loss just below this new demand zone. However, contrary to their expectations, price made a brief upward move, mitigated the upper supply, and then continued its bearish movement. This resulted in hitting the stop loss of traders who had taken long positions. They often fail to realize why their stop loss was triggered by the price, and unfortunately, they repeat these actions repeatedly. What they missed here is a crucial point. The price didn't reverse from any unmitigated demand zone. They shouldn't have entered a long position until the price reached a major unmitigated demand area. Their identified change of character was invalid, and the price only moved upwards to mitigate the upper supply zone. It used the last supply zone as an inducement zone to sweep more liquidity and gain more momentum to fuel its downward movement. This scenario highlights that without a proper understanding of market structure, you're likely to experience losses. Inexperienced traders could have avoided this if they had a better understanding of market sentiment. They would have noticed that their identified change of character was not valid because the price hadn't reached the higher timeframe demand zone yet. Now, let's move into the next confluence criteria, the time of day and week. When dealing with higher timeframes such as 4-hour or 1-hour charts, it's essential to take into account how close you are to the weekend. Additionally, consider the time of day and the trading sessions. It's advisable to steer clear of trading during the final hour of the trading day, particularly on Fridays. During this time, liquidity tends to dry up and spreads can widen, introducing higher risks into your trades. Imagine you've identified a flawless and perfect trading setup, one that aligns perfectly with your trading plan. Offering an exceptionally high probability of success, the price is on the brink of reaching your highlighted point of interest, and you've set an appropriately small stop loss, creating an ideal trade opportunity. However, here's the twist. The market is lacking the necessary momentum and liquidity.
This might happen during the last hours of Friday, the Asian session, or in the late hours, like around 12 p.m. or 5 a.m. In such cases, the likelihood of this trade becoming a winner is rather low. To trade successfully at the right times, you need to know how the market acts during different parts of the day. So we have fully covered the confluences and criteria that we need to consider in order to identify optimum trade setups with a high probability of success. Now, let's explore the ideal trading scenarios based on the smart money concept. In this first optimal trading scenario, imagine that we are trading at the perfect time of the day when the market has sufficient momentum and volatility. We've also thoroughly assessed the market structure and identified the directional bias of the price. All these factors align to indicate a potential selling opportunity. In this scenario, the price is in a downtrend, and supplies are dominating the market. The price has recently broken out of this low to the downside, leaving a significant inefficiency in its wake. Consequently, a newly generated supply zone has emerged on the extreme, resulting from the recent bearish break of structure. It's crucial that this point of interest remains unmitigated after the initial downward movement. The price retraced back up, forming equal highs just below our extreme point of interest. At this level, a substantial liquidity pool has been established. It's important to note that the existence of a liquidity pool near the point of interest is essential for validating the setup before entering the trade. It becomes crucial to identify a liquidity sweep pattern occurring just before the price reaches the point of interest. The presence of a liquidity pool beneath our identified supply zone significantly increases the probability of a potential price reversal from this zone. Traders who have placed their buy orders and stop losses within this liquidity pool are essentially providing a potential fuel source for the market's downward momentum. As mentioned earlier, we use liquidity sweeps as a confluence factor before entering a position. The core mindset behind that is if the price fails to sweep liquidity before reaching a point of interest, there is a high probability that the price will utilize that zone as liquidity to fuel its momentum. After forming equal highs, the price experienced a downward push, breaking the recent low and establishing a break of structure. It's important to note a key aspect here. We don't necessarily require the price to mitigate a demand zone and then start moving to the upside. This step is not obligatory because predicting when and where the price will reverse is inherently uncertain. What we anticipate in this scenario is for the price to move upward, sweeping the liquidity accumulated above the equal lows, then entering the identified point of interest, mitigating it, and subsequently reversing to the downside, sustaining its downward movement. This optimal trading setup presents an opportunity to enter the market from our identified point of interest, utilizing the various entry models based on the smart money concepts covered in detail in previous episodes. As you analyze the charts, this setup represents one of the primary types of trading opportunities you should be on the lookout for. Now let's examine an example of this trading scenario. Here we have the 1-hour time frame of the euro-dollar pair displayed. It's obvious that prices in a downtrend and supplies are in control. If we shift our attention to the top of the chart, we can see that price has broken out of this structure with significant inefficiency and momentum. It has also generated an unmitigated and fresh supply zone at the extreme. Subsequently, after a temporary retracement, the price began to move downward, resulting in a bearish break of structure and the formation of another supply zone. However, in the subsequent movements, we can see that the price retraced back toward the last supply zone and created perfect liquidity with the formation of equal highs in that area. The presence of this liquidity pool below our identified supply zones increases the probability of a potential price reversal from our identified extreme supply zone. As you can see, the price rose back up and utilized the last supply zone as an inducement area. It also swept the liquidity above the equal highs, so we have the desired confluence that we were seeking in our analysis. Now the only thing left to do is wait for the price to enter the extreme supply zone, at which point we can set up an entry based on the various entry models explained in our previous episodes. Following the smart money concepts, for example, we could employ the aggressive entry model by placing a sell limit order at the lowest point of the supply area. Alternatively, we can opt for a more conservative approach by seeking additional confirmation, such as waiting for the price to form multiple reversal patterns, like a change of character in the current or lower time frames. Ultimately, we would set our entries at the lower time frames to achieve a better reward to risk ratio thanks to the tighter stop loss. This was the perfect example of the optimum trading setups that I always looking for to enter a position in the market. The same concept applies to the bullish scenario. Now, let's delve into the next trading scenario. So here we have the second optimum trading scenario on the screen that we would like to see in the market. Let's imagine we have a structure like this one in this downtrend scenario where the price has created bearish breaks of structures. What I look for is the price after breaking and closing a structure and forming a supply zone. Retracing back up, it taps into the recently created point of interest experiences, a reversal, and then starts to move downside, leaving a significant inefficiency behind and initiating another break of structure. This confirms that supplies have control and we are still in a downtrend. In the next step, we are seeking a consolidation phase, such as equal lows. We need the price to form sell-side liquidity right at the bottom. If we take a look at the left side closely, we can see that the price has already swept the external liquidity. Now it's time for the price to target internal liquidity, as indicated by this fair value gap that was generated right after the first mitigation. Now, in the following steps, what we want to see is the price pushing upward, filling the liquidity void that was left earlier, and then entering into this unmitigated and fresh supply zone. Our next step is to zoom into the lower time frame and search for any signs of a change of character or reversal confirmation patterns. This allows us to set an optimum entry. This scenario is one of the safest trading setups and tends to be effective most of the time. Let's now see a real chart example to illustrate this concept. Here we have one. Our pound-yen chart is displayed on the screen. As you can see, The price's general direction is bearish, and it has formed a series of downward breaking structures. Price has cleared the liquidity above these equal highs. After mitigating this demand zone, it reversed its direction and moved downward with momentum, leaving a significant inefficiency behind. Upon closer examination, this price action corresponds to our first optimum trading scenario. A liquidity pool was created just below the unmitigated supply zone. Subsequently, the price moved upward, cleared the liquidity accumulated above the equal highs, and then reversed from the upper supply zone. So, this would have been my first entry if I were monitoring this currency pair. Next, we can see that price moved downward, leaving a significant inefficiency behind. The price then retraced upward, but didn't reach the upper fresh supply zone. Instead, it moved downward again, confirming that supplies are controlling the market. Additionally, the price created a perfect sell-side liquidity pool below the equal lows. Subsequently, the price moved upward to fill the internal liquidity left behind. After a clear mitigation over the fresh supply zone, price changed its direction to the downside. We could have entered a short position here after detecting a change of character pattern and a lower time frame analysis. Let's delve into the details of the third optimum trading scenario. Consider a bearish structure, like the one presented in this scenario. We want to see several key events. Firstly, the price must reverse from a higher time frame supply zone. For example, a 4-hour point of interest. Next, we look for the creation of a large order block identified by a candle with a large body. Subsequently, we anticipate the price to move downward, confirming that supplies are controlling the market. After forming a lower low, indicating sell-side liquidity, the price retrace is upward to fill the gaps left behind and mitigate the order block at the extreme. Notice that price changes its direction towards the upper large order block during its temporary bullish movement to the upside, resulting in the creation of bullish order blocks. Now, what we want to see is that the price enters the zone of the large order block and experiences a reversal without mitigating the majority of the order block. In this scenario, it's crucial to notice the voids left inside the candle that require mitigation. Subsequently, the price moves downward, forming an internal high that indicates buy-side liquidity. Moving forward, it's essential to closely monitor the price behavior as it approaches the bullish order block. We need the price to reverse from the bullish order block start moving upward. Utilize the last supply zone as an inducement. Trigger the stop loss of traders who entered a short position from the last demand zone and sweep the buy-side liquidity accumulated above the internal high. Eventually, it should tap into the large order block, and after acceptable mitigation, the price gets reversed, moving straight back down towards the sell side, liquidity located at the bottom to take advantage of the scenario as prices tapped into the large order block. We should zoom into the lower time frame and look for any signs of a change of character formed by the price. Then we are permitted to place a short position. Now, let's proceed to the price chart and see an example of it. Here we have the Euro-Dollar 1-hour time frame on the chart. Initially, the price moved upward until it reached the 4-hour time frame's supply zone, reacted to it, and then reversed its direction. Subsequently, the price created a change of character by breaking and closing below the structure. Then price moved upward to mitigate the order block generated by the change of character wave. As the price continued its downward direction, it created another break of structure and also formed this unmitigated large bearish order block here in the subsequent price action. We see that the price moved downward, leaving a significant inefficiency. It continued this downward momentum, breaking through multiple structures, confirming a shift in its direction. With supplies now in control of the market, until it reached this low point where it faced resistance reversed and established equal lows, forming a notable sell-side liquidity. Later on, the price reversed its direction, pushing upward. Although it mitigated the order block, it couldn't fully mitigate the majority of it. Following this, there was a temporary downward movement. After mitigating this bullish order block,
The price reversed and moved upward, utilizing the last supply zone as an inducement. This move hit the stop loss of traders who had entered short positions from that zone. Price ultimately mitigated the large order block at the extreme once again. Following this, a substantial reversal occurred, with the price strongly moving downward and gaining significant momentum toward the sell-side liquidity. This trading scenario offers essential advantages. including a more refined point of interest, a safer entry point with a high win rate and a high reward-to-risk ratio. Additionally, it provides the most suitable time to enter the market by filtering out risky entries.